The S&P 500 and the NASDAQ pulling back from record highs as the Nvidia-driven rally taking a bit of a breather here. Our next guest says it might be time for investors to rebalance their portfolios amid all the tech concentration. Scott Wren, Wells Fargo Investment Institute Senior Global Market Strategist, joins us now. Scott, great to have you with us. Thank you so much for being here. Look, in your note, you say the thing that makes us all sit up. It's time to trim tech and comm services to neutral ratings as the S&P 500 is making new highs and investors should rebalance. Why now for that call? Why not just enjoy the tech gains of it all for another 6 months or so?
Well, Maddie, you're right. And you know, if you could pick the top in a momentum market before you have a halfway decent correction, it'd make it a lot easier. But I think right now is what we're trying to do is we think those two sectors that you mentioned, comm services and tech, very highly valued, very momentum driven. And what we want to try to do is trim some of those gains and buy things like industrials and materials, energy. We've also been buying a little bit of healthcare. So we think those sectors are undervalued. The other ones are overvalued. You know, we'd be very hesitant to just go out and buy the S&P 500, but I think you have to look under the hood and do a little bit of work under the hood. And a lot of this is, you know, you need to be patient, and you need to realize that, you know, picking the top in any particular run is always difficult. You know, we want to be invested here. The market we think will be higher than where we are right now at the end of 2025, but we think we'll probably have a bumpy road that'll provide some opportunities and equities between now and then.
Scott, big themes are typically easy for investors to try and wrap their minds around what the runway might look like. And that theme has largely been AI to this point, and generative AI. What is, though, if we were to see some type of rotation or profit taking even and spreading the chips around elsewhere, what are other comfortable themes that investors can be comfortable with for a long-term time horizon right now?
Well, you know, Brad, I think one thing you want to point out is that, you know, industrials and materials, you know, all this AI build out, whether it's data centers, updates to the electrical grid, all those kinds of things, you know, the companies that are going to be building those are in the industrial sector. And certainly there's going to be a lot of copper and other types of industrial metals used, which is in the material sector. So, you know, those two sectors play out with those themes. But I think overall, you know, you need to think about the economy here probably for the next few quarters, 3-4 quarters. You're going to see sub 2% growth in GDP, somewhere between 1.5% and 2%. You know, inflation's going to come down, but it's going to take a little bit of time. So I think right now you want to position for what might, or start to position for what might happen after this slowdown. I think you're going to see the second half of 2025 be better globally. I think you'll finally see these developed international markets, maybe emerging markets, start to do better. But the U.S. is going to lead the charge. So I think for now, you still want to be overweight U.S. relative to industrials. You still want to play the large cap theme. You know, we've been underweight small cap stocks, the Russell 2000, for a couple of years. I think that still has a ways to go. So I think right now you want to just make some moves around the edges. You want to be a little cautious here, but you want to have a plan, because when the pullback occurs, and you know, I'll say, you know, right up front that, you know, we thought we'd see another 10% pullback by now, and it hasn't happened. But it's going to happen at some point. You need to have a plan. A lot of investors, retail investors, have cash on the sidelines. You need to know what you want to buy. And then, of course, when you see a 10% pullback, you have to do the hardest thing for most retail investors, is just to kind of hold their nose and stick their toe in and execute the plan. So we're trying to be patient here. We think you'll have a opportunity at higher rates, a higher 10-year yield to buy some longer duration bonds. We also think you'll have an opportunity to buy stocks at lower levels.
Scott, what causes the 10% decline in the market?
Well, Maddie, I think it's going to continue to revolve around is inflation going to come off fast enough for the Federal Reserve to cut? We're only looking for 2 cuts this year, and I'm telling you, if we're wrong, I think it's going to be fewer cuts, not more. We're only looking for 1 cut next year, which of course the median dot was at 4. So I think it's going to revolve around inflation staying higher for longer, and then at some point, consumers are starting to back off here. We think that'll happen more as the economy slows. So I think it'll be a combination of higher inflation and a slower economy. That'll spook a few people and cause a little bit of money to come out of the market and give you that opportunity.
Scott, with the opportunities, we love it. Scott Wren, Wells Fargo Investment Institute Senior Global Market Strategist. Thanks for joining us here on this Friday, Scott. Great to see you.
Have a great weekend, guys. Thank you.